In 33 AD, the Roman Empire experienced the world's first recorded real estate market collapse. Within weeks, the entire financial system seized. This wasn't just ancient history, it's the blueprint for every market crash you've seen in your lifetime. The technology that triggered it wasn't computers or the internet. It was something far more fundamental to how empires transfer wealth, real estate investment vehicles, and the world's first lending infrastructure. The innovation that Rome created allowed wealth to move at speeds that no civilization had ever seen before. And the lessons Wall Street learned from this collapse, they're applying them right now, in real time, to markets worth trillions of dollars. Let me show you how an empire's innovation in financial technology created a bubble so catastrophic, it nearly destroyed Rome itself. We're going to trace the exact mechanism that turned Rome's greatest strength, its sophisticated financial system, into the weapon that almost killed it, and why every real estate market collapse since then, from the tulip mania to 2008 to the challenges facing today's markets, follows the exact same pattern that was established 2,000 years ago. By 33 AD, Rome had perfected something revolutionary, a standardized lending market backed by real estate collateral. For the first time in history, wealthy Romans could leverage their real estate holdings to generate passive income through loans. The technology was elegantly simple but transformative. Documented contracts with legal force, enforced property rights, protected by the state, and a comprehensive legal framework that made debt tradable as a commodity. This was the birth of modern finance. This wasn't just about lending money between neighbors or funding a single merchant voyage. Rome had created the world's first systematic investment strategy based entirely on real estate collateral. Senators and patricians didn't just own land for agricultural production or social status, they used it as leverage to multiply their wealth exponentially through complex lending chains. One property could back multiple loans simultaneously through different legal structures. Sound familiar? It should. This is the ancient world's version of mortgage-backed securities. The mechanics were elegant in their simplicity, but devastating in their consequences. A wealthy Roman patrician would pledge his properties, urban apartments, agricultural estates, commercial buildings, as security and lend money at interest rates that varied wildly, anywhere from 12 to 48% annually depending on the risk profile of the borrower. These loans funded everything from merchant expeditions to India, to political campaigns in the Forum, to the construction of new properties that would themselves become collateral. The real estate backing these transactions made them feel absolutely secure. After all, land doesn't disappear. Buildings remain. The collateral seemed permanent. But here's where Roman financial technology created a systemic vulnerability that nobody saw coming, a blind spot that would prove catastrophic. The Senate had passed a series of laws over the decades, most notably the Lex Julia introduced under Augustus, requiring that 2/3 of every senator's wealth be invested in Italian real estate. This wasn't a gentle suggestion or a recommended portfolio diversification strategy. It was mandatory allocation enforced by law, with severe penalties for noncompliance, including loss of senatorial status. Think carefully about what this legal requirement created at a structural level. You had a market where the wealthiest, most powerful investors in the empire, the men who controlled armies, provinces, and the levers of government, were legally forced to concentrate their entire investment strategy into a single asset class. The entire Roman elite, hundreds of the richest families in human history, had their wealth locked into real estate. And that real estate was simultaneously serving as collateral for even more lending, creating layers of leverage stacked on top of leverage. The concentration was staggering. The interconnection was total. By 33 AD, the system had reached maximum velocity. Capital was flowing through the empire at unprecedented rates. Money moved from Italy to Egypt to Gaul and back again, all secured by property deeds and loan contracts. Real estate prices in Rome and across the Italian peninsula had climbed steadily for decades without a major correction. Every indicator, every metric that Roman investors tracked, suggested the market could only continue its upward trajectory. The technology of Roman finance had created what seemed like a perpetual wealth generation machine. Fortunes were being made not through production or trade, but through the financial engineering of real estate leverage. Then Emperor Tiberius made a decision that would trigger the collapse. Facing mounting political pressure from conservative senators concerned about moral decline and usury, and dealing with several high-profile scandals involving predatory lending, he ordered strict enforcement of old usury laws that had been casually ignored for generations. Ancient statutes limiting interest rates and regulating lending practices were suddenly being applied with imperial authority. Overnight, thousands of loans that had been standard practice, loans that violated technical interest rate caps or lacked proper documentation, became illegal. The entire lending market froze instantly. Here's where the real estate connection becomes absolutely critical to understanding the cascade. With the lending market frozen by imperial decree, Romans who had used their properties as collateral suddenly couldn't roll over their loans when they came due. The standard practice had been to take out a new loan to pay off an old one, keeping the leverage game going indefinitely. Now that refinancing mechanism was gone, they needed to raise cash immediately to meet their obligations. And there was only one way to generate that much liquidity that quickly: sell real estate into the open market. But when everyone tries to sell real estate at the same time, there are no buyers at any price. It's a fundamental law of illiquid markets. Property values didn't just decline, they collapsed completely. Assets that had been worth millions of sesterces, properties that had been in families for generations, couldn't find purchasers at 10% of their previous valuations. The technology that had made real estate the perfect collateral, its permanence, its tangibility, its apparent stability, now made it a death trap. You couldn't sell it, but you still owed the money it was supposed to secure. The crisis accelerated with terrifying speed, moving from individual failures to systemic collapse in a matter of weeks. Rome's wealthiest families, names that had been prominent since the Republic, faced total financial ruin. Senators who owned vast estates across Italy, who controlled the grain supply, who commanded legions, couldn't meet their basic obligations. Banks, the Argentieri who facilitated these transactions, began failing as their loan portfolios became worthless. The entire financial infrastructure, all the sophisticated technology of contracts and lending vehicles and investment structures, all of it depended on a single assumption: that real estate would maintain its value. When that assumption broke, everything broke simultaneously. The Senate convened an emergency session, understanding that this had moved beyond a financial crisis into an existential threat to Roman stability. These weren't just investors facing margin calls. These were the men who ran the empire, who maintained the legions, who kept the provinces in line. Their personal financial collapse meant Rome itself was at risk of political disintegration. If the senatorial class fell, who would govern? Who would command the armies? The crisis threatened the very structure of imperial power. Tiberius, recognizing the magnitude of what his enforcement had triggered, responded with what historians now recognize as the world's first government bailout of a real estate market. He released 100 million sesterces from the imperial treasury, roughly 1/6 of Rome's entire annual revenue. An absolutely massive intervention, as interest-free loans designed to inject liquidity and stabilize collapsing property values. The money came with one carefully designed condition: it had to be secured by real estate collateral valued at twice the loan amount. The government was explicitly betting that property values would recover to some reasonable baseline. Think about the circular logic of that intervention for a moment. The same real estate that had just collapsed in value, the assets that couldn't find buyers at any price, were now being used as collateral for the rescue loans. The government was explicitly propping up property values by accepting them as security. They were reinflating the bubble with public money, using imperial funds to create artificial demand and establish a price floor. It was, in every sense, a bailout designed to prevent price discovery from completing its work. It worked, but barely, and at enormous cost. The injection of liquidity stopped the immediate panic. Real estate prices stabilized at levels well below their peaks, but above total collapse. The lending market slowly, cautiously reopened as confidence partially returned. Within a year, Rome's financial system was functioning again at a reduced but sustainable level. But the damage to individual wealth was permanent and severe. Families that had been among the richest in the world for generations were wiped out completely. The social upheaval lasted for decades. Now here's exactly why this matters to you today, and why understanding this pattern is worth more than any modern investment advice. Every single element of Rome's crisis appears, virtually unchanged in modern real estate collapses. In 2008, we had standardized mortgage securities and collateralized debt obligations, direct descendants of Rome's documented lending contracts. We had mandatory investment in real estate through pension fund requirements and banking regulations, the modern equivalent of Rome's Lex Julia. We had excessive leverage with banks operating at 30-1. Ratios, the same mathematical madness as Roman senators. We had a liquidity crisis when everyone tried to sell simultaneously and discovered there were no buyers. And we had a government bailout using the exact same fundamental logic that Tiberius applied. Inject massive liquidity into the system, accept real estate and mortgage-backed securities as collateral even though their value is questionable, and hope that prices recover before the whole structure collapses. The Federal Reserve's response in 2008, the TARP program, the mortgage relief initiatives, all of it was nearly identical in structure and logic to Tiberius's emergency intervention 19 centuries earlier. The scale was different, the technology was more complex, but the pattern was identical. The technology changes, the speed increases exponentially. The instruments become more sophisticated and abstract. But the fundamental pattern of real estate market collapse remains constant across millennia because it's rooted in unchangeable aspects of human behavior and basic market mechanics. Leverage amplifies gains during the boom, making fortunes appear out of thin air until inevitably it amplifies losses during the bust. Collateral works perfectly as security until everyone needs to liquidate simultaneously, at which point it becomes worthless. Government intervention can stop immediate panic and prevent total systemic failure, but it can't erase the underlying imbalance or restore wealth that was never real to begin with. Rome's crisis teaches us something that Wall Street doesn't want you to know. something that gets lost in the complexity of modern financial engineering. Real estate crashes aren't anomalies, they aren't failures of regulation or oversight, and they aren't preventable through better risk management. They're features built into any system that allows leveraged investment in illiquid assets. The very technology that makes real estate investable and allows it to serve as a store of wealth also makes it inherently vulnerable to cascading collapse when confidence breaks. The Romans recovered, but they never forgot the lessons of 33 AD. For generations afterward, Roman investors were dramatically more cautious about leverage ratios. Laws were passed limiting the concentration of senatorial wealth in single asset classes. The memory of the crisis created a deep cultural understanding of systemic risk and the dangers of excessive financial engineering. That institutional knowledge shaped Roman policy for over a century, but eventually, inevitably, it faded. It always does. Within a few generations, new investors who hadn't experienced the crisis personally, who only knew it as history, started building leverage again. The cycle began anew, which brings us to today's real estate market and the question every serious investor should be asking themselves: where exactly are we in the cycle right now? Look at the indicators. We have record leverage in commercial and residential real estate. We have properties being used as collateral for increasingly complex and abstract financial instruments. We have a widespread belief, almost religious in its intensity, that real estate in desirable markets can only go up over time. We have regulatory frameworks that encourage concentration in real estate investment. If you know Roman history, if you understand the pattern, this should sound extremely familiar. This should concern you. The original tech bubble wasn't .com stocks in 2000 or cryptocurrency in 2021. It was the Roman innovation in financial technology that turned real estate into leverage into speculation, and speculation into crisis. Every market collapse since then, every single one across 2 millennia, has been a variation on this fundamental theme that Rome established. Understanding what happened in 33 AD gives you a pattern recognition tool that's been accurate for 2,000 years of financial history. That's not theory. That's empirical data across centuries. But Rome's real estate crisis wasn't the first time that financial innovation created systemic risk in the ancient world. It wasn't even the first time that technology related to money itself caused a crisis that rippled across civilizations. It revealed something deeper about how empires handle not just real estate, but money itself, the physical currency that backed all those property transactions, the coins that flowed through those lending networks. Because 50 years before Rome's real estate collapse, a century before Tiberius faced his crisis, a different empire had already experienced a financial innovation crisis that was even more fundamental. This earlier crisis involved the currency system itself, not what you could buy with money, but what money actually was. And that innovation came from a king whose wealth was so legendary that his name became synonymous with riches for the next 3,000 years. That king revolutionized the nature of money in ways that made Rome's entire financial technology possible centuries later. His innovation in currency created both the greatest personal fortune the ancient world had ever seen and a template for monetary crisis that governments and central banks still follow today. He solved one problem and created 10 others. He made international trade possible and nearly destroyed his own kingdom in the process. The story begins in a kingdom to the east of Rome. In Anatolia, where rivers literally ran with gold dust and a civilization had discovered something that no one else in the world had figured out yet. In this kingdom, a king made a decision about currency that changed human civilization forever. He created standardized money. He invented the coin as we know it. And in doing so, he set in motion economic forces that neither he nor anyone else in the ancient world could fully control. His name was Croesus. He ruled the kingdom of Lydia, and what he did to money, the innovation he introduced to human commerce, makes modern central banking look primitive by comparison. The consequences of his monetary technology are still playing out in your bank account today.